You then went on and joined a venture capital firm.
I did.
And you looked at thousands of business proposals and invested in 100. What advice would you have for young entrepreneurs who are submitting business proposals to venture capitalists?
Yeah, so I would say the first thing is don't submit a business plan. That's not going to get you seen. Piles and piles of business plans sent unsolicited into venture capitalists is not where it's at. Where it's at is trying to really establish credibility in what you're doing and with other individuals that the investing community respects, and bring those individuals in to help you before you go to try to raise money. And that's what we did at COVID. Before we went out to raise our first venture capital round, we self-funded the company for about 9 months. But we also, during that time, created a board of advisors who were a set of highly qualified, capable, successful individuals, and we asked them to be our advisors to help us make sure that we were on the right track. We would get together once a quarter, and we would ask them to deal with questions that we didn't know the answer to.
Right.
When you're going for money or you have a lot of money in the bank, you can't be telling your venture capitalists that you don't know what you're doing, that you don't know the answer to these questions. Right. So having a group that you can rely on was very, very helpful.
Can you share some insights into the process of identifying promising startups?
The firm I was with had made investments in the non-tech area, the high-tech area, and the medical tech area. So each one is different in some of the things that you might be intrigued about or feel that was worth a risk of investment. But at the end of the day, venture capitalists who do this for a living, when they make an investment, every single investment they make is going to be a 10-fold winner or a 20-fold winner or more for their venture firm, or they wouldn't have made the investment.
Right.
Yet, at the end of the day, they'll lose money on 3 out of 10. Mm-hmm. They'll make a little bit of money on another 4 or 5 out of 10. And they hope that those first 8 break even. And the performance of the venture capital business is based on the 2 out of 10 that actually succeed. So it's like baseball. You got to get up and you got to take the swings in order to get the batting average.
Right.
And I guess I would say that that's one thing that entrepreneurs should also think about, that they're convinced that their idea is the best idea in the world, and yet their probability of being successful is 20%. And I think entrepreneurs, or some people who think about becoming entrepreneurs, will be too cautious. They don't want to take the risk of failure. And my advice to them is get out there, make the investment of your time, but expect that you will have to be involved in a couple of different startups before you find one that really lives up to your original expectations. But in the process, you get a ton of experience that's way more valuable than sitting in a little cubby in a current company whose destiny has already been determined.
Right. Good advice. Because entrepreneurship is about taking risks, right?
Right.
Yeah.
You're taking risks with your time as opposed to your capital.
That's right.